Hi everyone, welcome back. So here we are at the end of the year with time running out to affect your 2025 taxes. The end of the year is one of the most important times for real estate investors to get their taxes right. A lot of people wait until April to deal with taxes, but the truth is that almost all of the best tax moves expire on December 31st. So today I'm walking you through end of year tax strategies that could potentially save you thousands on your taxes. These apply whether you own rentals only or if you invest in the stock market in addition to real estate. I also want to give a shout out to Gio Bartolotta, CPA over at GoJo Accountants for helping me put this video together. Gio's contact info is down below in the description. So let's start with your brokerage account, because this can actually be one of the biggest levers real estate investors can use. If the market was choppy for you this year and you're sitting on some losing positions, you can turn those losses into real tax benefits. The strategy is called tax loss harvesting, and the idea is really simple. You sell the stock that's down, lock in the loss, and that loss becomes a tool you can use to offset gains from the sale of other stocks or rentals. And if you didn't have gains for the year, well, first of all, you should probably get off of Wall Street bets, but you can use up to $3,000 of losses from your brokerage account to offset other income, including the income from your rentals and your day job. Now, if you have more than $3,000 in losses, they don't disappear. They carry into future years until you use them up. And like I was mentioning, this is where things get really helpful for real estate investors, because those losses from your brokerage account don't just help you with your stock gains, they can also help when you sell a rental, even in situations where you don't think you owe any taxes. For example, imagine you bought a rental for $300,000 and a few years later you sell it for the exact same price. Most people look at that and think, I broke even, there's no profit, so there shouldn't be any taxes, right? But because you were taking depreciation on your tax return every year, maybe $30,000 total, the IRS treats that as money you already deducted, and when you sell, they want to tax that portion even if the property didn't go up in value. This is the part that catches people off guard. The sale price didn't change, but there's still a tax bill because of the depreciation you took over the years. Now here's the good news. If you have harvested losses in your brokerage account, maybe you sold some losing stocks and locked in $15,000 of losses, those losses can reduce the tax you owe on that straight line depreciation amount. So instead of being taxed on the full $30,000 you deducted over time, the losses from your investments can shrink that number and soften the hit. And depending on how much of a loss you have, they can wipe it out completely. One thing you need to watch out for though is the wash sale rule. If you sell a stock at a loss, you can't buy that same stock or anything essentially identical to it during a 61-day window. That window includes the 30 days before you sell, the day you sell, and the 30 days after. If you buy it anywhere in that window, the IRS disallows the loss and you don't get the deduction at that point. Now for my crypto bros in the audience, I have good news for you. Crypto is different because the wash sale rule doesn't apply to crypto. You can sell it, lock in the loss, and buy it back the same day if you want without it being labeled a wash sale. Now let's talk about what happens when you sell a rental property. Most people only think about taxes when they sell at a gain, but selling at a loss can actually create some of the strongest tax benefits for real estate investors. A loss on a rental isn't treated like an investment loss when selling a stock. It can offset income from your job, income from a business, income from other rentals, almost anything, with much higher limits than the $3,000 limit we just talked about for assets like stocks. So if you have a lot of income for 2025 and are selling a property at a loss, then you may want to hurry up and sell in 2025 instead of dragging your feet and waiting until next year. If you're selling a property at a loss this year, there's one thing you need to keep in mind going forward. That loss can definitely help your taxes this year, but it also starts a 5-year clock. And during those 5 years, if you sell another property at a gain, the IRS might not let you use the lower long-term capital gains rate on that future sale. For most people, that lower rate is about 15%. Instead, the IRS can make you pay your regular income tax rate on that part of the gain, which is usually much higher. Here's what that looks like in practice. Suppose you sell rental 1 this year and take a $20,000 loss. Then 2 years from now, you sell a different property, which we'll call rental 2, and make a $40,000 profit. Because that loss on rental 1 happened within the 5-year window, the IRS may tax the first $20,000 of profit on rental 2 at your regular income tax rate instead of the lower capital gains rate. Only the remaining $20,000 of profit on rental 2 would get the lower rate. The good news is that you have options. If you ever want to sell a property at a gain during that 5-year window, you can avoid this problem by simply waiting until the 5 years have passed so all your gains qualify for the lower rate again, or you can do a 1031 exchange to defer them. And speaking of 1031 exchanges, timing can become an issue for them at the end of the year. A lot of investors think that no matter when they sell, they automatically have 180 days to complete a 1031. That's not always true. The IRS says you only get the full 180 days if your tax return isn't due before then. For most people, the due date is April 15th. So if you sell a property late in the year, your 180-day window might actually get cut off. The only way to keep the full 180-day window open is to file for an extension. If you don't file the extension, the clock ends on April 15th, even if the calendar says you technically still have days left. So if you're selling in November or December, talk to your tax professional about an extension. It's a small step that protects the entire strategy. Let's move to qualified opportunity zones. The new tax bill has made these permanent with a new rule set, but in 2025, they still follow the original rules. If you sell stocks or other investments and you reinvest the gain into a qualified opportunity fund in 2025 or 2026, you can push the tax bill on the gain all the way into 2027. You're not erasing the tax, but you're giving yourself breathing room, which can make a big difference if you're juggling deals, renovations, or reserves. And last but not least, wrapping up our end of year tax discussion, here's one of the simplest end of year opportunities, the Augusta Rule. If you're traveling for the holidays and are looking to make some tax-free income, you can rent out your primary home for 14 days or less during the year. And that income is completely tax-free. You don't report it, you don't pay tax on it, and it's completely legal. So when you zoom out, all of these pieces start to work together. A decision you make in your brokerage account can ripple into the taxes you pay when you sell a rental. A loss on one property can soften the overall tax hit from your other income. The timing of a deal, especially at the end of the year, can be the difference between deferring taxes or accidentally triggering them. Once you see how connected everything is, the end of the year becomes less worrying about taxes and more about lining things up so each move supports the next. All right, if this video helped you out and you'd like to watch more content on financial planning for landlords, don't forget to hit subscribe. And now that we're closing out the year, enjoy the holidays, enjoy those tax savings you secured, and make time for the people who matter. I'll see you next time.